According to supply managers in the 9 Mid-America states, how is the economy performing?
Our August survey of supply managers in the 9 states, the overall index from that survey was up for the month, but still below growth neutral. The number for August was 49.5, which is up from July's 46.1. So it's slightly better, but still below growth neutral. Clearly the manufacturing economy, the regional economy is slowing down, and we're picking it up. We ask the supply managers to look forward, and of course these are men and women that are at the front end of the supply chain, and what they see today we tend to see later on. 45% of the supply managers expect a recession in the second half of 2023. Of course, this is for August, don't have many more months to go, so it's looking like we're going to see at least some downturn in the overall growth rate and potentially a recession. Only 27% of the supply managers expect to see growth in the regional economy going forward. Now here I bring up a chart that shows you in blue the Mid-America, the overall index for Mid-America. Now this is a composite of 5 sub-indices, and you see there the upturn for the month of August, and you see there the U.S. number, which is in red, and that the August number will come out later on this morning. I expect that to likewise be below growth neutral, but we're still on the verge of, I would say, slow to no to negative growth, but even that, the negative growth will be only slight. So this is not a full-blown recession we're seeing at this point in time.
What were the hiring trends?
Hiring for August was not good. The overall reading, all these numbers range between 0 and 150 is growth neutral. The number for August was 47.7, clearly below growth neutral, but up from July's 45.6. 1 in 7 of the supply managers reported job gains for the month, of course. Now this is down from last month when 1 in 5 reported job gains for the month. So again, it's not good in the labor market, looking less and less positive. We're still seeing even with that, we're still seeing a lot of labor hoarding. That is, holding on to workers, understanding that the ability to rehire is very limited right now, but we're seeing less and less of that labor hoarding each month. Job growth over the last year for the overall economy of the 9 states is at 1.7%. The U.S. economy during that same period of time, 12 months, was 2.2%. Now the manufacturing sector, we're seeing 3 months of declines now. That's very, very important, that overall and underreported in my judgment.
What inflation trends are you noticing?
Inflation, the gauge was up for the month. It rose to 63.7. That's up from July's 52.2. So we're seeing some real concern there that inflation is remaining with us at the same time the economy is slowing down. The Federal Reserve, I expect them to take note of this, our number, and also the national number, which I expect to be also in an inflationary range. The supply managers expect prices to grow by about 5% over the next 12 months. Of course, that's a concern for the Federal Reserve. They're looking at this. But also, one important thing we've not talked about in this monthly discussion on the surveys is the federal government continues to spending briskly, and that's going to show up in the numbers with inflation trending upward. And also the Federal Reserve is going to have to keep that in mind. The fiscal policy of the federal government is spend, 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 and that means higher interest rates from the Federal Reserve. When you're talking about the CPI, at least according to the Bureau of Labor Statistics, is cooling. We're seeing over the last 3 months 0.5 of 1 percentage point, and of course you multiply that by 4 and you're talking about 2%, which is right on target with the Federal Reserve's target. Now the core interest rate, the core inflation rate I should say, over the last 3 months is 0.8 of 1%. Now that is above the Fed's goal or the target, so that's a concern. When you look at the producer price index, did not even grow over the last 3 months, But now the services side, now that's overall. The services side on the other hand, grew at 0.6%. Well, multiply that by 4 and you get 2.4%, of course. So that's again above the Fed's target, but not much.
What is the economic outlook?
The outlook is slow to no to slightly negative growth in the third quarter, which we're in right now, and the fourth quarter, which is coming up shortly. We'll see a global economic downturn as it begins to affect the U.S. economy and the regional economy. We're talking about China moving into potentially negative territory. We're also talking about Germany, two of the largest global economies, are already in negative territory. So that's these big large economies are going to drag the U.S. growth rate down. There's little doubt about that. Keep an eye on real estate. The housing market's been pretty strong. I expect that to weaken in the months ahead. Also manufacturing, which we're reporting on today, that has not been good. Now to say it's very bad is not correct. It's just not quite as good, indicating slow to no to potentially slightly negative growth. We've got too much spending in the pipeline from the federal government, in my judgment. The Biden administration is increasing spending, and of course that's going to again push the Fed to increase interest rates, or at least be on track to raise interest rates, or be ready to move in interest rates. But keep an eye on the balance sheet. The balance sheet of the Federal Reserve is now between $8 and $9 trillion. When they tighten, which they are tightening now, that will mean higher long-term interest rates. Of course, that's tied to mortgage rates, so watch those. And I expect the CPI to, again for August, when it comes in September, to be about 0.2 percentage point. That's not bad. That's moving toward the Fed's target. And again, I expect the rate hike on the 19th and 20th of September. And I expect longer-term interest rates to move higher, but at a fairly slow pace. But mortgage rates are going to be rising. The prime interest rate will be 8.75% by the by the 21st of September. So watch that. And we're talking about keeping an eye on the bond market. If you're looking for investment opportunities right now, there's some really good rates on CDs, some really good rates on short-term treasuries, short-term CDs. Going out long-term is recommended by some advisors. I don't see that right now. That's too much risk for this conservative economist. That just makes me nervous to take those kind of risks in buying long-term bonds. Keep an eye on the 10-year Treasury yield. It's now moved up to 4.2%. Now that moves up much higher. You're talking about some concerns out there, and of course that's going to shake the Federal Reserve up a bit. And also a credit crisis. There is always a potential, or I shouldn't say always, in this period we're in right now, a credit crisis we could see that flare up again as we did in March with the failure of those three banks: Signature Bank, Silicon Valley Bank, and First Republic Bank. And keep an eye on the balance sheet, as I was saying. That's a very important metric to keep an eye on. The Fed doesn't talk much about it. The news media doesn't talk much about it at all, but it's very important right now. The Federal Reserve's balance sheet, as it gets smaller and smaller, which the Fed intends to do, that's just going to push up interest rates on the long end. And finally, watch out for the national ISM reading, which comes out later on this morning. I expect that number to be likewise, as the Creighton number, to be below growth neutral, a real concern. So that wraps it up for the month. It was not a good report, but it could have been worse. I expect the readings in the months ahead to likewise be very soft going forward. So until we meet again in the first business day of October, may your economic cup runneth over.